This is PBS, part of WHRO's year-round commitment to education. WHRO is counting on your support. Local broadcast of Wall Street Week is made possible in part by Checkered Flag Lynn Haven, where winners buy, home of the BMW driving machine at 2865 Virginia Beach Boulevard, and by
Wall Street Week with Rukeyser is made possible by the Corporation for Public Broadcasting and by the financial support of viewers like you. By the Travelers, nearly 40 million Americans benefit from our insurance, investment services, and managed health care. The Travelers. And by MFS. MFS, helping mutual fund and institutional investors achieve their financial goals since 1924. And by Prudential Securities, rock solid market-wise. Prudential Securities, celebrating 10 years on television with Wall Street Week with Rukeyser. Produced Friday, September 4. Our panelists are Eddie Brown, John Dessauer, and Martin Zweig. Tonight's special guest is George F. Keane, President, the Common Fund.
Good evening, I'm Rukeyser. This is Wall Street Week. Welcome back. Well, it's back to school time all across America. And the little darlings better study real hard this year if they want mommy and daddy to keep smiling at the prospect of the kid actually going to college. In the U.S. these days, higher education increasingly means high finance. And it's not about to get better. For the average family, and indeed for many with incomes well above average, keeping up with the projected future increases in college costs is a prospect approximately as daunting as paying off the national debt. Meanwhile, the educational institutions themselves keep singing the fiscal blues in a nonstop medley with the alma mater. 2 generations ago, it was almost every American family's proudest hope that the kids might go to college. Today, that hope is mingled with fear about how those bills are ever going to get paid. We tonight will look at that problem from a somewhat different angle. How good a job old Siwash is doing on its own at investing the endowment money that can help prevent all the costs from landing on the taxpayer or the at least semi-proud parents. It seemed the right nonpartisan thing to do tonight because one of the few things on which George Bush and Bill Clinton seem to agree is that we've got to do a much better job of educating our kids for the more competitive world of the 21st century. And speaking of education, 10 allegedly learned economists whose views were breathlessly reported by Dow Jones this week got a failing grade within 48 hours in predicting the August employment report. The consensus was that the unemployment rate would not fall below its previous 7.7%, but non-farm payrolls would add 155,000 jobs. The reality was the reverse. The unemployment rate dropped a notch, but so did payrolls, off by 83,000. And it would have been about 100,000 worse were it not for a federal summer jobs program. At first blush, not from the economists, but from the markets, this was taken as very serious indeed. Bonds soared on expectations of massive new easing by the monetary authorities. But on closer examination, it seemed probable that the report, while clearly disappointing, was not quite as catastrophic as first reported. Average hours worked, for example, were on the rise, and so were average earnings. And when the Federal Reserve, apparently making the same analysis, sliced its federal funds rate by a mere quarter point and left its key discount rate untouched, bonds lost some of their gains, and the stock market took only a small hit, leaving it ahead for the week. Still, nobody thought this economy was about to receive a diploma, magna cum laude or otherwise. Reports this week showed sags in home sales and construction, a drop in new factory orders, and only the tiniest advance in the government's attempt to forecast the economy, its index of leading indicators. All in all, while the grudging, almost comatose economic recovery was still technically alive, it plainly was not rebounding with anything resembling the strength that the Bush campaign had hoped. And there aren't that many report cards left between now and November 3rd. We, as always, will be trying to upgrade you and your finances to an A+. So let's see what the naughty kids in Wall Street were up to in the week just past. The Dow Jones Industrial Average withstood the late week worries about less than booming employment to put together its second straight 14-point weekly gain, rising 14.31 to 3281.92. And all the broader market indexes finished with advances for the week as well. As for our elves, whose index stands on its buy signal until it gets to -5 or greater, the consensus of 10 leading technicians remains at -1 on the outlook for the next 6 months. Big winner of the week was conservative old Treasury bonds, whose prices rose as long-term interest rates dipped near 7.25%. Big loser was the American dollar, which lost even more ground against every major foreign currency except the Japanese yen. And just when we all have been instructed to stop using chlorofluorocarbons and fear the menace of global warming, turns out that the summer of 1992, which you might have missed entirely if you nodded off at the wrong time, was in fact the third coolest in recorded history. Oh well, at least this fall we'll be able to count on the political hot air. Marty Zweig, is the weak dollar keeping the Fed from lowering interest rates as much as it should to jumpstart the economy?
I think it is. German interest rates are 500 or 600 percentage points, 5 or 6 percentage points higher than ours, and it's hard to lower your rates with that kind of competition. Any move to lower the rates here would probably weaken the dollar even more, and it's tough.
You've expressed concern for a long time about the slow growth of the money supply. What would you do at this point?
If I were the Fed?
Yeah,
or
we'll put you in charge.
Investor? Oh, I'd like that job.
Well, let's do it first. First give advice to the Fed, then to the investor.
I think the Fed has done a pretty good job. They've correctly lowered interest rates the last couple of years. Unfortunately, I think they've used up most of their ammunition. The money supply is not growing, but not because of the Fed. The banks can't loan money or won't loan money. There are not enough good borrowers around. You need the borrowing to do it.
Is government regulation still too tight?
I think the government bank regulators put the fear of God into the banks, and the banks are afraid to loan, and they're sitting with a lot of government securities rather than loans, and that's slowing down the economy.
And now we've straightened out the Fed. How about investors?
I would probably gravitate towards intermediate-term bonds. I'm not wild about the stock market. I think it's sort of a neutral case right now. Bonds at least have the economy going for them. That is a very slow economy and no inflation.
Intermediate term would be what, 3 to 7 years? Or?
Yeah, something like that. I'm too chicken to go out 20 or 30 years.
Would you stick to Treasury bonds, or would you use high-grade corporate bonds?
I would stick to Treasuries, but it's okay to buy the long-term corporates, but they're more illiquid. That's why I like the Treasuries.
Okay, John Dessauer. Marty says time for a little caution here. What's your view?
Well, I think, Lou, there are some equity markets around the world that can be very exciting. We've seen the Japanese stock market up 25% from its lows in the last couple of weeks. And that could happen in other places as well. Taiwan is a candidate. At one of these days, the Bundesbank in Germany will get pushed to the wall and cut their rates. And I think when that happens, there'll be some explosive upward motion in European stock markets as well.
John, you watch these world markets closely all the time. Why are the Germans keeping interest rates so high?
Well, they've got a double problem there. One is the cost of financing the unification with Eastern Germany, and they're afraid that if they're too easy, that a lot of that debt will be monetized, meaning just turn straight into inflation. The other problem is real inflation, meaning they gave a lot of very good money to people in Eastern Germany. They turned around and bought a lot of Western products and drove up inflation temporarily. So the Bundesbank has been fighting that kind of a battle, but it's over now, really. The inflation rate in Germany is coming down. The unification costs are beginning to stabilize.
When would you expect to see interest rates starting down over there?
The pressure on the Bundesbank is enormous, and I would be surprised if we don't see real downward motion by the end of this year. But the Bundesbank will not lead the way down. We will see open market rates in Germany come down, interest rates come down there in the marketplace, and then the Bundesbank will rapidly follow. Sometime very soon, I hope in the next couple of months.
Ed Brown, what's your assessment these days?
Well, we've had a very risk-averse market. A lot of the low volatility stocks have done much better than the high volatility stocks until this week. In the last couple of weeks, we've seen, especially this week, we've seen the technology stocks do extremely well. A company like BMC Software over the past couple of weeks up 20%.
And even some of the computer makers have been doing pretty well.
Right.
Now, is this the suggestion that maybe the economy is going to be a little better than people believe?
No, I don't think so. The economy is still very, very tough, and it's going to be tough to get out of this.
And how do you sell computers in a weak economy?
Well, you don't sell too many, and that's the problem. What's going on in the market, as I see it, is just a vicious rotation, and that rotation is likely to continue. But I'm really surprised how resilient the market has been in light of the weak dollar and everything else. You know, it's holding very well.
Seems to be one of those revolving corrections in which we hit one group and then another. But would you stay in at this point? Would you get in if you were not in?
Yes, I think it's justified to have some money in the market, primarily because I think earnings will be pretty decent in 1993, and the market still seems, you know, reasonably valued on 1993's prospects. But in between, it's going to be more of the same, up and down, you know, but no big moves either way.
Gotcha. In any event, panelists, it's time now to try and put our viewers in a holiday mood. Marty Zweig, we know you know everything about stocks from Alpha to Omega, but Randall Chung of San Bernardino, California, wants to take you only as far as Beta. He'd like to know the meaning of the financial terms Alpha and Beta, whether an individual can calculate them himself, and how useful they are in identifying stocks worthy of investment.
Well, we'll start with beta. Beta is a measure of a stock's volatility or a portfolio's volatility relative to the market. A beta of 1 would mean that a stock has the same volatility as the market. A beta of 2 means the stock is twice as volatile. If the market goes up 10%, the stock might go up 20 and vice versa. Alpha is a measure of the excess returns above that predicted by beta. To put that in English, suppose the stock has a beta of 1, it should move in line with the market. If the market's up 10 and the stock's up 15 over a period, the difference would be the alpha, or 5%. That stock did risk-adjusted 5% more than the market. The problem is that just because that happened in the past, it's not necessarily predictive. And yes, you can calculate it yourself, but you don't have to, because a lot of services will do it for you.
Do you find them useful, those alphas and betas?
I think that alpha, no. Beta, yeah, it's nice to know a stock's volatility. It gives you an approximate idea of how volatile and how risky a stock would be.
All righty. John Dessauer, a number of viewers have sent us questions about the recent pounding taken by the U.S. dollar. Rajiv Karlekar of East Brunswick, New Jersey, wonders whether this wouldn't be an ideal time for foreigners to be using their stronger currencies to buy our stocks. And both David Howell of El Paso, Texas, and Arthur Miller of Naples, Florida, are curious about how American investors can profit from a future rebound of the dollar.
Well, the first part of the question goes like this. During the first 4 months of this year, foreign investors were net sellers of about $3.4 billion worth of U.S. stocks. As long as the dollar is going down, they will tend to be sellers because they are afraid of the dollar going down some more or the Fed raising interest rates. Once the dollar stabilizes, or better yet, starts its way back up again, that's when we can expect the foreign investors to come rushing in. As far as profiting from a rebound, the way to look at that is to say what might cause the rebound. And that can happen in one of two ways: higher interest rates here or lower interest rates in Europe. The latter would be my choice. And there you would want to buy stocks both in Europe and in the United States, because our market probably would follow the Europeans as well.
All righty. Ed Brown, James Matera of Atlanta, Georgia, describes himself as an avid baseball fan and investor who is looking for what he shamelessly calls some attractive pitches on how to make money from the sport. He's really hoping to find some publicly owned minor league baseball team, but he'll listen to whatever you want to throw him.
Unfortunately, he can't get in the game. There are no publicly traded minor league baseball plays to get in. There are some major league teams that are owned by publicly held companies. For example, Tribune Company, Chicago Cubs, Turner Broadcasting, Atlanta Braves, Anheuser-Busch, St. Louis Cardinals. But unfortunately, it's a very tiny portion of their overall business. There's only one publicly held sports team that I know of, and that's the Boston Celtics Limited Partnership. I wouldn't guarantee a dunk shot, however.
Might bounce, though? All righty. Now, if life's been throwing you a curve, or if you're just tired of striking out in the money game, we'll be happy to help you get into the swing so you can hit a few home runs into the seats of luxury. So if you're looking for more than just a clever pitch in the double play of life and lucre, wind up your cares and toss your worries to our financial fielders here at Wall Street Week, Owings Mills, Maryland, 21117. That's Wall Street Week, Owings Mills, Maryland, 21117. Now, before we meet tonight's special guest, who is the largest single figure on the college endowment scene today, let's see what it means for an institution to be well endowed. An endowment is a gift or bequest of money or property that is given for the permanent support of an institution. The first record of the term is found in the Middle Ages, when land was given to endow churches, with the income from agriculture used for their support. In the 1600s and 1700s, the concept was extended to support colleges and universities. Nowadays, the form of endowment property is less likely to be real estate than stocks and bonds, but endowments are still expected to be invested in perpetuity, with only the income used to support the institution. The endowment funds of educational institutions in the U.S. amount to about $70 billion and generate $3.8 billion a year to help support some 1,800 colleges, universities, and independent schools. Harvard's endowment of $4.7 billion tops the list, followed by those of the University of Texas, Princeton, Yale, and Stanford. But my guest runs more money than any of these, fully $7 billion in endowments for 736 educational institutions. And that sum doesn't include another $7 billion in his cash management program. How does he keep this money working as hard as the students are supposed to be? For some answers, let's go over now and meet tonight's special guest, George F. Keane. George, welcome. We're very pleased to have you here.
Thanks, Lou.
Please. George Keane is the only president the Common Fund has had since it was established as a nonprofit service corporation in 1971 by a small group of educational institutions with the help of a grant from the Ford Foundation. The fund's growth has paralleled the explosion in college costs since then. Mr. Keane has reason to take more than just a professional interest in this subject. He has 6 grandchildren, ranging in age from 2 to 12, and they will all presumably have to pay some tuition of their own. George, how is investing in an endowment fund different from any other kind of investing?
Lou, there are 2 characteristics that are probably the most important differences. One is that, as your introduction mentioned, endowment funds are a perpetual source of support for colleges, so they can take a very long-term time horizon in their investing. And the other is that inflation is really the biggest threat to college endowment funds. Their purchasing power will be eroded. And so growth of income over time is very important. And in the Common Fund, we've tried to grow our income at least double the rate of inflation over the last 20 years.
What's the breakdown of that $7 billion? How much stocks, how much bonds, what else is there?
Well, it's about $4 billion in stocks and about $3 billion in bonds. And a little more than 2/3 of it is domestic and about 1/3 is international.
If you have such concern over fighting inflation, why do you have so many bonds?
Well, the bonds are not really a matter of our choice. We make available to our member colleges bond and stock investment programs, and they then choose the asset mix that they wish. We'll provide them with counseling, and we generally advocate 2/3 to 3/4 in equity-type investments, possibly stocks, but also real estate and other equities.
Now, am I right that you don't actively manage this money, you choose money managers to manage it? Is that correct?
The colleges have been safe for the whole 20 years. I have not picked a single stock.
How many money managers do you use?
We have about 65 managers for all of our programs, about 25 for our stock investment programs. And they pick the stocks, and they're very good at it.
How do you choose the money managers?
We look for managers that have very clearly defined investment strategies, that they have had a demonstrated record of success, that they've applied consistently over a period of time, and very capable people who have helped create that strategy and produce the results, who are still there and are likely to continue to be there, and a good record of performance.
I don't want this to shock you, George, but we have some people watching this program with less than $7 billion in assets. What can you tell them in terms of what these people are buying now that might be sensible long-term investments for them?
Well, I can just run down a few examples of things that some of our managers are buying. For example, Michael Price, who's a noted long-term value investor, likes Solomon Brothers, thinks it's a cheap stock at 1.1 times earnings, thinks they have a fabulous franchise and that the stock's been under a cloud because of the bond trading scandal, but thinks that the new management is going to be very strong under Warren Buffett's leadership and will do well. John Levin, who's another value-oriented investor, likes Biogen. Biogen is, like many of the biotech stocks, a stock that is now selling about half of its peak, but it's a company that has a lot of cash, a lot of cash flow from royalties, has an important new product, an anticoagulant drug, and good management, and he likes that one. Who else? John Fullerton out in California is an eclectic, opportunistic stock investor with a fantastic 10-year record. John likes a company called Space Labs Medical, which is a company that makes and installs and services patient monitoring systems in hospitals, and is selling for 11 times earnings and growing about 15%.
With the proviso that even heavy hitters like those can strike out now and then, let me move you to another area. The college campuses have been alive for a generation with controversy about where money should be invested. South Africa, environmental causes, smoking, so forth. How much inhibition are you under in investing this money?
We have always had some significant involvement on the South African issue, and most colleges today either limit their investments to companies that meet certain standards of performance in South Africa or don't invest in companies that are doing business there at all. And I think that will continue until there's a new constitution and representative government in South Africa. In the other areas, I think the greatest emphasis in recent years has been on corporate governance, concern about green mail, golden parachutes, and other colorful things.
In your honor, we've assembled an unusually highly educated panel tonight, so let's turn to them, starting with Marty Zweig.
George, in recent years, a lot of pension money went into real estate investments, and real estate's gone south. Are you a bottom fisher in that area, and if so, have you put money into real estate?
Marty, we're a buyer of real estate and have been for the last few years. We've got about a $400 million real estate program going, and we think this is an ideal time, taking a long-term view, to be acquiring first quality property that's income producing and well leased, and we're planning to do a lot more real estate investing in the next few years.
George, you started a global equity investment program this year. Everyone else seems to be interested in bonds overseas because of high interest rates. Does this mean that you think there's a better future for foreign equities than foreign bonds?
John, I think foreign bonds are quite attractive because of the high yields and the strong currencies, but global stocks in certain areas are very attractive. The European market, for example, is selling at roughly 6 to 7 times cash flow, which is the level at which people used to try to do leverage buyouts. And other countries like Australia have very attractively priced stocks. And we think that the global markets make a lot of sense.
George, one perennial concern of endowment funds of all types, and even individuals with portfolios, is kind of the spending rule, whether they should tap the principal, just spend the current income, or spend on a total return basis. What's your view?
Ed, our view is that spending ought to be determined by the return that can be earned on investments net of inflation, and that it should not matter whether that comes from dividends and interest or whether it comes from a total return. And our experience over many, many years now of looking at capital markets and their returns suggests that spending in the range of 5 to 5.5% is quite supportable if an endowment fund has a significant commitment to equity. If they have a lower commitment to equity, they ought to reduce their spending rate. If they have a higher commitment to equity, they might spend a little bit more.
George, many big institutions these days are getting involved, at least in a hedging way, in the futures market. Have you done that or been tempted to?
We have had a lot of involvement with futures, Lou, in 2 areas. One is in providing equity exposure for cash in our portfolios,
By buying stock index futures?
By buying S&P index futures. The other is using index futures to hedge either bond or stock investments on a tactical asset allocation basis. And that's been an up and down program, worked extremely well in 1987, hedging us out of the market crash completely. Didn't work well in 88 and 89, but over the 10 years that we've been doing it, it's added about 1% a year.
You've said the only quarter a trustee ought to be concerned about is a quarter of a century. Is there a message there for individual investors?
I have to attribute that quote to Roger Murray, who was a wonderful economist and one of the founding trustees of the Common Fund 20 years ago, but I agree with it. And he is emphasizing the long-term nature of endowments and the fact that you can get whipsawed if you take too short-term a view.
In your own investing, do you go for a longer-term perspective?
I certainly do. My own personal investing, are you
Yes.
talking about? I very much do, and I've done that for many, many years. I invested almost entirely in stocks when I was young. Now that I'm old, I'm getting a little bit more conservative.
Well, I think you're premature in making the judgment that you're old. Thanks very much, George Keane, for being with us tonight. Thanks to our panel. I hope you'll be back with us again next week. Then we'll see if you can get a jolt out of the electric utilities. My guest will be one of Wall Street's top analysts of utility stocks, Sandy Cohn. And we'll look at that group's prospects for income and for gains, and in general at its ability to light up your life. Meanwhile, this has been Wall Street Week. I'm Louis Rukeyser. Good night.
Wall Street Week with Louis Rukeyser has been made possible by the Corporation for Public Broadcasting and by the financial support of viewers like you. By the Travelers, providing American business with insurance, investment services, and managed health care. The Travelers. And by MFS. MFS, helping mutual fund and institutional investors achieve their financial goals since 1924. And by Prudential Securities, rock solid market-wise. Prudential Securities, celebrating 10 years on television with Wall Street Week with Louis Rukeyser. For a printed transcript of this program, send $5 to Transcripts. Wall Street Week with Louis Rukeyser, Owings Mills, Maryland, 21117. Transcripts are also available to subscribers of the Dow Jones News Retrieval Service. Wall Street Week with Louis Rukeyser is produced by Maryland Public Television, which is solely responsible for its content.
This is PBS. Local broadcast of Wall Street Week is made possible in part by Checkered Flag Lynn Haven, where winners buy, home of the BMW driving machine at 2865 Virginia Beach Boulevard.
This summer, WHRO took a risk in canceling 7 days of our August membership drive. I want to thank you for confirming our trust. Your generous support makes thousands of hours of quality programming that WHRO presents each year possible. We hope you'll fulfill your pledge at your earliest convenience. And thank you again for joining with us and making public television for Hampton Roads available to all.
I remember voting in 1928, and not for Hoover. I've seen New Deals, New Frontiers, and Give 'em Hell, Harry. I've lived in the free country for 83 years. I think about that every time I vote.
This election, make an intelligent choice. Turn to the McNeil-Lehrer NewsHour for key campaign coverage, because nobody's vote is more important than yours.
If you listen, you can hear it. A cry for help from 14 million children trying to learn in a world of drugs, poverty, pregnancy, and crime. A cry from the edge. Now, with public television's help, their cry is being heard. In community after community, see how educators and parents are responding to this cry from the edge.
Part of WHRO's year-round commitment to education.